is calculated using regression analysis. It helps an investor see the volatility or the aggressiveness a stock has compared against the rest of the market. A beta of 1 equals the market, so a stock with a beta of 1 will move succinctly with the market. A stock with a beta of less than 1 will move less than the market, and a stock with a beta of more than 1 will move more than the market. So if the market is going up and you have a stock with a higher than 1 beta, it will move up even farther. But if the market moves down, the higher than 1 beta will move down farther. It's more volatile. So a blue chip will be somewhere in the range of 1. A small cap technology stock might have with very high growth potential might have a very high beta, and a defensive stock or a bond would have a very low beta.
You find the beta by using regression analysis, but you don't have to do that. You can just go to Google Finance and type in your ticker, and there it is, already calculated for you. So GM would have 1.69, so that's above 1. GE, also above 1. Telecom will have a low one, so there's AT&T at 0.4.
So if a market is trending one way or the other, you could use the beta to make better decisions. So theoretically, if you had an upward trending market, you could buy a high beta stock and it would outpace the market and increase your yield. If you had a downward trending market, you could buy a low beta stock and it would maintain its value better against the decline. Alpha is what an investor generates on top of beta. If a beta of 1 is the market, then you could think of it like a total stock index fund. And those are very tough to beat in the long run. They almost always beat hedge funds. So an alpha investor is actually trying to create returns better than the market returns. So if an investor returns 6% over a year and the market returned 5.5%, the alpha that this investor generated was 0.5%. It's hard to generate alpha over the long term, just like it's hard to outperform any market over the long term.